Recording in progress, even though I did not get the sound, but I think that's because we had the AI going. But anywho, this is the September Patreon AMA. It is good to be here again. Obviously, there's a lot to talk about, especially after how crazy some of the August stuff was. And we already have a zillion questions. So for now, I'm just going to be going off the questions that were submitted on the website. And the first one is from Derek, which is if you were given a $30,000 small account to trade as opposed to, say, a $1 million account, would you trade any differently and have different risk management rules? If so, can you talk about more about risk management for different account sizes? I don't think it's necessarily the dollar amount that's so relevant, but more so your own situation that's so relevant. For example, if someone loses the 30K and they're never going to be able to refund that account, and if somebody loses the $1 million and they're never going to be able to refund that account, then you're kind of in the same position. But if you lose 30K and you're just trading part-time and you've got a full-time job where you've got a lot of savings and you can reload, then it's not so big of a deal. Obviously, if $1 million is your whole lifetime savings and you implode that, that's way worse than if 30K is just play money for you from your full-time job or something. But nevertheless, like beyond some personal, I guess, criteria and qualifications, I don't think things would change that much between a 30K account and a $1 million account. Sorry, got to mute that. So I do think that for the most part, regardless of the account size, like trading is just trading. What does change though is of course the ability to grow that account. It's way easier to grow a 30K account than it is to grow a $1 million account, just because not every opportunity has the same scalability. So that being said, like if you have a, let's call it 5%, if we want to go based on percentages, if you have a 5% daily stop and you're risking 1,500 on a 30K account and you're risking 50K on a $1 million account. Yeah, I think I did that math right. It doesn't really work that way because like there might not necessarily be the opportunities or the scalability for you to risk 50K. So even though I mean, I was trading, 10 million plus at Trillium, right? And my stop often just wouldn't come into play because on most days I didn't want to risk anywhere close to my stop. So at large account sizes, on the big stuff, you might want to go really big, but on the average days, it just doesn't really apply. Like inevitably on a 30K account, there's definitely going to be places where I don't mind risking $1,500, but on a million, take even a $10 million account, there's almost never a place where I want to risk 500K. Not never, but it's probably once every couple times a month I might want to risk 500K. So that does become way different, I guess. But overall, like my systems and everything else would still be very similar. Again, it's just the scalability thing. So that's a long-winded way of saying like nuances will change, but not that much. And I think Derek's on the call. So Derek, let me know if that made sense or not, or if I can expand further on it. But I think that's the gist of it. Like overall, if you're growing an account, the principles always remain the same. The stuff that treats you well at 30K, while it might slightly change, the rules really will, the best practices you develop will stay good for you. So DC asked if with Traders for a Cause in Vegas approaching, is there any chance for a Patreon meetup in case anyone is going? Oh, good. Happy to hear, Derek, that made sense. Is there any chance for a Patreon meetup? I will say yes. I don't know exactly when I'll be able to pull it off, but I think that seems like a good idea and a good thing to do for you all. Just as a question real quick, are any of you guys going to Traders for a Cause? I'm kind of curious if we're talking like 2 people or 10 people. Mark will be there. Awesome. That'll be great to see you, Mark.
I'll be here as well.
Awesome. Great, Phil. So, I mean, just the fact that already brings it to 3, I'll probably inevitably end up doing something. Maybe we'll do I don't know what we'll do, but yes, the answer then is yes. I'll schedule a meetup at some point once we know schedules better, and that's an awesome idea, especially to help connect some of you all. I think it's really great when we get you all interconnected, helping each other, working together, and everything else. All right. A question from Mattia, if I think I'm pronouncing that correctly. How often did I trade when I was actively trading? Did I only wait for the 4 to 5 big opportunities of the month, or did I scalp and trade every day? Assuming that you traded frequently, can you explain what types of scalps were in your playbook, specifically from the stock selection to the approach to this type of trade? So when I was actively trading, I was trading extreme amounts every single day. I mean, I was probably averaging 1 million+ shares per day, most days. So this was doing the big ops, it was doing the small ops, it was doing small scalps, little order flow things. So the answer is nowadays I only trade the really big stuff just because my life is so much different now, right? I'm doing a nonprofit work. I'm working on the course. I'm trying to be healthier and not sitting behind a computer for 12 hours a day anymore. So as a result of that, it's way more conducive to my life overall to just be focusing on the big ops. And what's amazing is like I've been able to still do super, super well. I mean, obviously, I'm leaving money on the table in otherwise that I would be making day to day. But because I focus so much on the big stuff now, and because I'm just pretty experienced at this point, like I don't think my skills trading the big stuff have gotten worse. I would argue I think I'm actually at the top of my game right now. Between the GME and the AMC trading I did, which I think was super elite. Like that was some of the proudest trading I did. Then I think the August trading was, I mean, that was without a doubt my best trade ever by a mile. And so it's like, I think what I lack in nimbleness and just technology and everything else now, I make up for with a just deeper understanding of market structure. And I think I've been able to just continually refine my thinking on some of these just really, really big days, and increased confidence and everything else. But as far as the scalps, I mean, what did these look like? It's almost like impossible to answer in the realm of just a short AMA. I mean, this could be everything from little order flow moves where a stock is in SSRM and there's an offer kind of pegging lower. As the offer decrements, you try to be the last couple thousand shares that take that offer. It pops up 5-10 cents, you kick it out. It could be something like there's a big breakout level at $10. We're really pressing against. There's an offer at $10. I want to be the last one to take a couple thousand shares at $10, kick it out 10:04, 10:07, 10:09. Other scalps could be something like there's a news headline that I don't think is going to be that big of a deal, but I do think if I can be one of the first people to buy that headline, there's going to be people after me buying it higher. Another thing for scalps might be, like potential. There's an IPO and it's going to open at $40.03 with large bids at $40. I might buy 40.03 and scalp out, $40.13, $40.20. So it's a lot of, I would say, just quick momentum plays where you get a really just quick reaction. And I tend to be faster and more tuned into the level 2 box that allows me to make those little scalps. One question real quick based on some of this was, so would you suggest us to take 4 to 5 ops a month approach like you are doing right now? No, I wouldn't, just because like I mean, for me, I'm just doing what makes sense for my circumstances, right? And my circumstances are I can't be glued to the screen all day, nor do I choose to be, just for health reasons at this point. But if you are going to be, you need to be getting reps. And keep in mind, if you're only saying, I want to play pocket aces, you're leaving a ton of money on the table. Like if you're only playing aces, you're leaving a ton of money from kings, queens, jacks, tens, jack, queen, king, queen, ace, king. So you definitely want to be trading anything that you think has edge. Stuff like these scalps that I'm describing, if that's in your playbook. Stuff like breaking news headlines, if that's in your playbook. I mean, I essentially have near zero ability to catch a breaking news headline anymore, right? Like that used to be a huge portion of my P&L. But I'm not sitting in front of a computer, just hawking after these news sources. So what I'm doing is generally extremely suboptimal for you all. I'm doing what makes sense for my stage in my life and career, but for you all, you want reps. It's like it's one of those things where you need to see all those hands play out. Even if you're not trading the hands, you still want to see the different hands. You still want to be playing ones that you expect to have positive expected value, because all of that P&L adds up, right? And especially for developing traders, what happens the most for the growth of a developing trader is you build this playbook of your easy money trades, and maybe you make $200, $500, $1,000 over the course of the month. You're able to put up a couple, maybe $5,000, $6,000, $7,000. Then when you get a really, really good opportunity that month, rather than risking $1,000, you might be able to risk 2,000. And that's when growth really starts to take off. When you're able to parlay some of the proceeds of the easy money trades and then turn them and bet part of it onto the really good ops, that is when people just take off like wildfire. And that's what leads to massive growth. And just from, like, if you're sitting at that desk, you should always try to, if there's something really, really moving, even if you're not trading it, you want to be watching it and training your eye to see these patterns, to see the level 2 box and everything else. So the caveat, and this is a good thing that I touch on it in the course, is I have a video on the stages of trader development and what you should be working on, because so many people, when they give advice, like, what I do is what's right for me right now. What Lucas Short Bear does is what's right for Lucas right now. That does not mean it's right for others, because everyone's at a different stage. So that was a good question. I hope all of that helps. Again, I'm just trying to blaze through some of these from the online so then we can get deeper into this stuff. Ozzy, who is in the Zoom, had asked, how do I stay on top of news and preparation for possible material catalysts and ongoing stories? Please explain like I am 5 years old, if possible. Well, baby Ozzy, ooh, Bella entered the chat, but I don't think that's Bella Fiore. I think we have another Bella, an imposter Bella. Well, baby Ozzy, what I would say is baby Ozzy read, baby Ozzy prep catalysts, baby Ozzy buy sell. So I think to stay on top of news and stuff, what you really want to be doing, like, there's no perfect way. Like, it's not as if there's just some magical way to just know what catalysts are coming up. A lot of it is just a matter of staying informed. So what are some different ways to stay informed? That might be using the resources that your news services. Oh, sorry, we're still getting more people joining. We got good old Dominic in the house. And so to stay on top of some of that stuff, it's like Trade the News, for example, is a news service, a news aggregator, and they have really, really good catalyst summaries. They have really good upcoming events. Bloomberg does catalyst calendars for biotech, for all sorts of stuff. Briefing.com has different catalyst calendars. So my first answer would be, like, a lot of news sources help you aggregate some of these upcoming catalysts and do research as part of the subscription price. The other way I think that is good is, like, just simply listening to CNBC during the trading day. Like, if if you're listening to nothing else or have no audio, like, you might as well just be listening to CNBC. A lot of times they'll talk about upcoming events and you get a feel for what these traders, analysts, hedge fund managers are interested in. Reading the Wall Street Journal potentially. There's also websites like BioRunUp. BioRunUp is a website that has a Catalyst calendar, I think, for biotechs. If I'm not mistaken, they should still do that. Generally, Adam Feuerstein of Stat News, he tends to do this biotech scorecard of upcoming drug trials. And what I do also is I keep not anymore because I just don't have the bandwidth, but what we used to do as an office, and so this is a great task to do with your pod. We would keep an Excel sheet and everybody would try to contribute one or two catalysts. So maybe someone was interested in biotech, they would add one or two there. Maybe I was aware of okay, there's going to be an OPEC meeting this month. There's going to be a Fed meeting this month. There's going to be a court patent this month. Maybe I know this pending merger is waiting approval. So what I would do with my pod or as an office when I was running the office is we would all just try to create this shared database. And so I think a really good best practice is to do that with some of your pod mates. And again, where do you find that stuff? Just by paying attention and reading some of these things, especially once you have certain news sources, like especially on Bloomberg, you can read a lot of analyst commentary on some of the Bloomberg first words. So they'll say, expected approval in Q1 or expected drug data in this month, or there's an upcoming tariff decision on that month. So there's no super concise way other than it's kind of your job to try to be as informed as possible. And the more you immerse yourself or team up with others, it helps. Does that kind of help Ozzy? I know it's not like some magical solution.
No, that's perfect. Can you hear me, by the way? Hello?
Yep, I can hear you.
Oh,
Yep.
yeah, no, that's perfect. Just to give some context, I mean, it all kind of stemmed from there was a DJT headline on Friday about like the lockup and he wasn't selling, and I kind of just wanted to get some advice on how to stay prepared and on
Yeah,
top of
I mean,
that
it's
stuff.
tough because that came out because like Trump was at a conference, right, or whatever, and it's like, I mean,
He
here's
said
the
he said I'm not selling.
yeah,
But the real context was that analysts days before
yeah.
started to
There's
say
all
that Trump is going to down the stock if he loses the election because the legal stuff that he has to deal with, etc.
yeah,
And he came, he showing and saying that was like a, a lost battle for the shorts because that thing had a 19.24% short flow.
yeah,
So that's really what happened.
yeah. And one other thing too that I don't think most people would say, Ozzy, but for a lot of times, I think Catalyst preparation and game planning is generally not people's most effective use of their time. Which, like, the issue is a lot of times you're just going to miss catalysts. Like, I don't know too many people that were on like paying attention to that California conference because the reality is Trump goes to a lot of conferences and stuff, and it's like there's always so many events out there, and if you spend too much time prepping for game plans and catalysts, like a lot of times some of these catalysts just won't unfold or it will happen pre-market or after hours or overnight. And so like I would do some work, like, but in no way would it exceed like hours per week. Like I think an appropriate amount of time to prep for catalyst and game planning is maybe you spend a half hour to or an hour or two per week, but for most people it's just not going to be the highest ROI. Like if you don't have a consistent system, if you don't have consistent easy money trades, you don't want to overly prep for these catalysts that just may or may not happen. Then paradoxically, some of the biggest, most watched catalysts I find actually end up crowded and kind of hard to trade. So it's like I think a lot of people do catalyst research in place of doing the hard work and figuring out like, hey, what do I actually need to be doing to make money? Like what data crunching, what research on like Edge and developing my system, rather than it's just kind of easier to read the Wall Street Journal each day and be like, oh, I'm working so hard. Like you might be putting time in, but it's often not like no matter what, you always want to be doing you want to be allocating your time to where it's going to have the highest impact on the P&L. And like, so it's the right answer is probably less than a couple hours per week, but greater than 0. But if you're doing, 5, 10, 20 hours a week of Catalyst research, I mean, at the end of the day, we're just not like it's not going to be probably the most effective.
Thank you, Lance.
Yep. So Kushal asked, hey, Lance, what practices helped you decrease the human error type mistakes in your trading, like entering trades that are not according to your plan due to FOMO or emotional tilt? Did you see this decreasing as you gained more experience? Did you ever reach a point where you made 0 human mistakes? The short, easy answer is I definitely never, ever reached a point where I would make 0 human mistakes. You will always make human mistakes, and that's the downside of being a human discretionary trader. That being said, I do think that as you gain experience, you tend to make less mistakes. Like you're more aware of your biases, you're more aware of what tends to be traps. But like, I don't know a single trader that doesn't make just some super, super dumb mistakes. Like, I mean, these could be as simple as trading stuff that they shouldn't be trading when they shouldn't be trading. I mean, even late in my career, the amount of times when I would be trading when I should not be trading at all, meaning like, I was sick or I was distracted or I was dealing with stuff. Those are just some of the lowest hanging fruit. Like if you're ever like, like the amount of times like you would get some trader in the office, like running like a 103 fever and like super sick. And you'd have to be like, dude, just go the fuck home. Like you're not like, not only are you going to get everyone sick, but you can't trade. Like trading's hard enough. You don't want to ever trade when like you're sick, distracted, or just like a totally unfocused mess. So like, I think we all make that mistake where like, it's like, oh, got back from the bachelor party at 2 a.m. Monday morning. I'm definitely going to wake up early and prep and trade. Like those are super easy human mistakes to avoid. But even as far as FOMO and emotional tilt, of course, like everyone does that. The question then becomes is like, how can you be more aware of it and minimize it? What are the causes of that tilt? Like if I know I tend to get tilted when I see oh man, the tweets of how much money everyone made, what I'm going to do is I'm going to mute those accounts, or I'm going to block those accounts, or I'm going to block Twitter. If I start to go on tilt, if I make 2 mistakes in a row, what I'm going to do is I'm going to try and create a rule or have my risk manager help me implement a rule where I can't trade after 2 losses in a row on the same ticker. So this, I mean, I could probably spend 2 hours on this question, but the short answer is yes, like we all make mistakes, and we're not never trying to be perfect, but we're just trying to be our best self, and it's never going to be perfect, and you just don't want to beat yourself up over human errors. You just want to set better systems in place to improve. Let me know if that doesn't answer, because I know you're on the Zoom as well. So Robert O'Shea asked an interesting question, which was, have you worked on patience on exits? I see you use the break of prior bars as a trailing stop, but for other bigger trades, how do you stay bigger picture trades? How do you stay patient and not leave money on the table? I have plenty of good trades, but exit too early too often. So the real question is, I don't want to use the word patient. Like, what does patient even mean? And do I want to presume that holding my trades longer equals that I'm going to make more money? I don't necessarily think, like, it's not about being patient. It's about what is the right stop, right? I use prior bars generally because it's my belief that once that trend breaks, I want to get out. So if patient means holding longer, and if I'm holding as something bounces, then it breaks, like I don't want to be patient. The second that trend breaks, I want to get the hell out. I don't want to wait another second. I don't want to wait. I don't want to wait a bar. I don't want to wait a minute. I don't want to wait a second. I don't want to be patient at all. So it's not at all about being patient. It's about using the right stop. And like, it's also not about, do you have good trades that you exit too early? Like inevitably we'll always have trades that keep going. The question is, are you using the right stop in the aggregate? If you force yourself to hold longer, do some trades then get worse? And so it's more so, are you using the right stop? If you're not holding to your stop and you know it's the right stop, that's a separate issue. And that's where, if you can't, like, inevitably as humans, we need to execute according to our plan. And to some degree, like, that always falls on you. And if you can't, my thought would be, is there a way to automate some of that? Is there a way to program? If your stop is, I need to hold 10 minutes, can you enter a program that says, okay, my stop will be in 10 minutes? Or if it's a certain price, can you just manually enter that or automate that and make it so that you're not the constraint? So it's not about being patient per se. It's about finding the stop that leads to the best outcomes in the aggregate, then taking it each time. And again, we will always leave money on the table, right? Like, there's always going to be times where just some stuff bounces really, really well. It's not about that. It's about finding the best thing in the aggregate. Does that all make sense to people? Because I think that's important, right? It's like, think about August 5th, like, stuff bounced insanely well. Like, stuff had over a 100% retracement. So in theory, you can beat yourself up, but it's like, I know that in the aggregate that generally doesn't happen. That was just a phenomenal bounce. And like, the risk reward when something has bounced back 90% is generally not as favorable when we've bounced 90% versus when we were way down there. I don't want the same size all the way up here that I had when we were down there, because that's not correct either. In the aggregate, you're going to get absolutely ruined. If I wait for a 120% bounce every single time, I'm going to just get torn up in the aggregate. So Jake had asked, how have you applied principles of the book, The Gap in the Game, to your trading and/or life? I remember in one of your videos, my biggest trade 8-5 was before that was in oil, and I worked blah, blah, blah. How did I divide my time in the evening of learning a new skill versus reviewing trades? So first, for context on The Gap in the Game, that was a book, I think it's by Dan Sullivan, but I might just be totally making that up. I don't know why I said that, but it's this book, and the guy essentially argues that so often in life, we focus on the gap, meaning where we feel we are lacking and not achieving. Like, oh man, I was supposed to have X amount by this age, and I was supposed to be this and that. And oh my God, like, I golfed well, but I didn't get the trophy. I wasn't first place. And we don't spend enough time looking back at our progress. Oh, wow, just 6 months ago, I didn't know how to hold a club. Wow, 1 year ago, I wasn't a profitable trader. 10 years ago, I did not have a stable income. And so psychologically, it's just human nature that we're always just focusing on the gap and we're beating ourselves up. And psychologically, we're making things very hard on ourselves. And I think especially with high performance traders like we tend to be, we especially fall victim to that. So many traders play the comparison game, and so many traders focus on, oh man, I could have made this amount of money. Oh man, I could have held that trade a little bit better. And so how is it applied to my life? I would say, just from a pure psychological basis, like, I could have held my trade way better on August 5th, but nevertheless, it was that was my best trade ever. And there I am thinking, oh my God, I could have held that so much better. But we need to break those habits because it's just not healthy or optimal. And so I think it's just a good life perspective. Like, just don't forget the progress you've made. Like, sometimes, obviously, I think some people know now I'm trying to get not shitty at golf. And there'll be times when I go to the range and I just totally suck. And it's just like, oh my God, how am I still so bad? Like, I've been practicing like 2 months now. How am I this crappy? But it's like, wait. Like, I'm focusing on the gap of where I think where my skills should be. And I'm forgetting that, like, no, Lance, like 2 months ago, like, you sucked way more than that. Like, at least now you really have a swing. And like, yes, I had to rebuild the swing, but I'm so much further than where I was. And so I'd say it's just a good life mindset to have in trading and throughout. We're so quick to just focus on our flaws and what we're lacking rather than what we have and everything else. So how do I divide my time in the evening of learning a new skill versus reviewing trades? So I think a lot, it depends where you are at and what stage of development you're at. So if you're a beginner and you don't really have any strategies yet or anything, you're really going to want to spend that time on developing new ones. If you don't have strategies yet to refine, it doesn't make much sense to review your current trading. You need to build that foundation. And so I think like a lot of times you need to just always be asking yourself, like, what practice and what use of my time is going to have the most, like the greatest impact on my P&L or whatever I'm trying to achieve. So like there will be times where the market is slow. And if the market's slow, that to Ozzy's question earlier, in a slow market, that's not a bad time to maybe dedicate more time to catalyst research. If the market's really, really active, like if it's like an August 5th week or something, I'm spending zero time preparing for catalysts. I'm spending zero time, researching different news stories because it's just not what my best use of time is. There's going to be times when it's slow that you can then build other skill sets and other stuff. So it really depends the market, and the driving thought for me always is to invest my time where it's going to be most effective. So Rajan hit me with a shit ton of questions. So I'm going to probably avoid some of these just for length, but also hit some of them for now. And maybe I'll go back to some of them. So one question that I think is kind of interesting here, I mean, they're all good, but there's just some constraints to how many I can get to. The maximum share size that you can put on in a given trade before you start moving the price. How much size can you use before encountering significant slippage? Do you have any strategies to avoid such slippage? So I think this is where let me restart. For most traders, especially beginners, like slippage is just not really going to be that relevant. It's not something most traders need to worry about. Obviously, as you start to grow and you start to trade bigger size, then it does become more relevant, especially if you're trading like low floats and micro caps more so than say like SPY or futures or something. And so that's where once you're trading a size that's going to impact how easily you can get in and out, you need to have a really, really good feel for the expected value of the trade. And that's because like generally trading is a very thin margin game. It's not as if trading is so easy that if you start, like take some of the scalping strategies, for example. When I was saying I want to buy the, $10 as we break a level, if I'm able to buy $10 and get out at $9.99 or $9.98, and I can sell at 10.04 and 10.07 and 10.09, that is a way different strategy. If I'm going to buy 20,000 shares, and to buy 20,000 shares, I need to buy from $10 to $10.05, because then for me to make money, I might need to get $10.15, and I might not be able to get out of that position until $9.95 or $9.90. So a lot really depends on using the level 2 book, having a feel for how much volume and liquidity is going off, and then having a feel over time for how that impacts your expected value. So a lot of this, the nice part is most people don't go from trading 100 shares to 10,000 overnight. And so for a lot of people, if you're doing it properly, you're growing very, very gradually, and you're able to develop that feel gradually. And so I know if I'm doing a scalp, for example, where if I'm buying at $10 and I want to kick it out at $10.04, $10.06, and I want to risk just a couple pennies, I can't afford to get any size that's going to just really cause a couple pennies of slippage. So that's where like the level 2 box and the book really, really matters, and knowing how that's going to impact the math. And of course, it's just estimates, but you're going to develop that gradually. And you're going to have times where instead of getting 1,000 shares, you get 3,000. Then when the trade doesn't work, you're like, oh crap, like rather than hitting 9.98, you're hitting 9.95. So a lot of that kind of comes as you develop. Then of course, there's times where you're going to realize, wow, like I could be getting so much size and it's not even going to impact the trade one bit. For example, say you're trading SPY or Apple, and you're only getting, 50 shares. You could get 500 shares and it's not going to change anything, or 5,000 probably. And so where traders really start to grow, I think, is when they're hitting their base hits, then like their easy money trades, but then they're starting to actually really push the size in those trades. And they recognize that there's a lot of trades that they're doing that don't have much slippage. When you have a easy money trade that you can increase in size without affecting the trade, that is generally the lowest hanging fruit to grow. So that's my general thoughts on that. He was also excited about my health series. Do you know when it will be coming out? It's one of those things that I just don't want to stress for myself, especially given the priority on magnum opus. That being said, I did reserve a podcast, a recording studio, for early November, where I'm going to do an episode with my really good friend who's an amazing holistic health guru. So I will at least be getting some type of awesome interview. I think this one will be similar to my Katz interview, whereas the Katz interview was on psychology. This one will be on just big picture health. So I'm hoping I'll get that recorded in early November and get that out by the end of the year. But yeah, the health series is definitely taking the back seat to me just needing to reach my self-imposed deadline for the course, which is in peak things. But do I recommend the Oura Ring? Absolutely. The Oura Ring is like, obviously people have different money sensitivities. But the Oura Ring, I think, is just such an amazing tool if used properly. Anything can be used unhealthily or maladaptively, but yes, the Oura Ring has led to way more accountability and way more improved behaviors on my sleep. Any other health tech that I consider a must-have, I don't think too much health tech is essential, but what I do think is sleep is so important to your trading. If you are not trying to optimize your sleep and you are if your trading P&L exceeds 4 figures, meaning if your trading days are 1,000 plus, 2,000, 3,000, 4,000, whatever, plus or minus, and you're not trying to optimize your sleep, it to me is just totally foolish. People don't take me seriously enough when I say this, which is mind boggling because I just kind of complain about it so much. So many people underestimate sleep and how important it is for your learning and your trading. And I see it with the traders all the time, but that part of being young and naive, like I said at the beginning of the call before we started recording, is you don't know you never believe stuff until you experience it yourself. So if you are probably a 4-figure trader where your trades on average are 1,000 plus or minus, to me, it's a no-brainer if you're going to take the small amount of effort to use it and improve your sleep practices. Why do I think these markets have extreme outlier days like panic days or capitulations? As markets become more efficient and participants more sophisticated over time, do you think the frequency of these outlier days might decrease? So one interesting thing that I would question is are markets always becoming more efficient? I'm not really sure that's true anymore. This dude, Cliff Asness, I think I'm getting that. I might be botching this too, but there's this really famous hedge fund manager that issued a shareholder letter, treatise on how he thinks markets are actually getting more inefficient and that the volatility swings are increasing. And over time, markets do get more efficient, but I'm not sure that's always true. I'm sure 10, 20, 100 years from now, it will be true. But I'm not sure that look at 2020 and 2021. That was some of the craziest trading we've ever seen. Look at the meme stock behavior that's been going on. The meme stock stuff, that's not efficient. When I first started my career, you would never, ever get moves like that. It was unfathomable for $1 billion company to move like that. The other thing that I would point out is with the advent of these 0 DTE options, I do think some stuff is actually getting more volatile out there. I do think a lot of these stocks are making really crazy moves. The moves we saw in the semis were so absurd. the semis have been moving so much on that pendulum back and forth. So while I do think markets increase in efficiency over like a 10, 20, 50, 100-year period, yeah, I don't know what to think anymore because there's been some super weird market structure stuff going on. But I do think there will always be panic days just because psychology and human nature always exist and always have existed. So let me pause for there actually for now, because I know there's a lot of other questions I'm skipping from there, but that's good. So then Usman, I know I'm botching everyone's name. I'm sorry. We've all sorts of names, and I definitely don't know how to pronounce all these. So Usman, I believe. Can you please go over the lower high concept in a little bit more detail? And sure. So this is something that's come up in a couple questions and a couple AMAs over time. And it's simply that after a really large capitulation, you tend to not break those lows again. And I know I'm talking about a higher low, but higher low, lower high, it's kind of the same thing. So we got this, this GOF is just a closed-end fund that I really like using as an example. We got this massive, huge capitulation and like insane price move for a closed-end fund. So after such a big panic, after this price capitulation, after this huge volume capitulation, so often we might get this higher low where things start to roll over, but now people get another opportunity to buy close to there. And generally after these huge blowouts, volatility contracts and prices find a range. So oftentimes this can be an amazing opportunity to buy. This happens on all time frames. Like for example, let's like this is another daily one that we've talked about, where this had this huge capitulation, we start to curl up. But again, a lot of people are looking to sell there or to short. And so it's simply just a common, I would say, market structure and psychology pattern where after huge blowout capitulations, we tend, it doesn't mean it's impossible, but we tend to not roll over. And instead, volatility tends to contract and price tends to form a range. Very, very, very common that happens. And I would also say there's a lot of times that's been covered in past AMAs. So if you're like some of the newer subscribers, don't be afraid to go back and rewatch those because we have a lot of examples and we talk about it on like an intraday basis quite a lot. And there's a lot of examples that are going to also help you there too. So Carl asked, oops, I typed Carl. That's not what I want. Carl asked about, can I go over LASE on 9-11? Absolutely. So this is probably going to be, I suspect a top op. Not that this was some home run trade, but just I think it's worth covering for September, come the end of the month. So this is a stock. It's been around a while. It's not, it's been around couple years now. It's not some, new listing, Chinese IPO or anything like that. This stock did, however, have a pretty decent run up. So we get up bar, up bar, up bar, up bar, up bar. So this is a really big move on the daily. What then happens is we break the trend and we have this huge panic. And so what I want to say and point out is, and this will come up in Magnum Opus as well. A lot of times the moving average on the daily can be a point of support. And there's this concept that I haven't touched on that much, but it's called like the sweet spot. And the sweet spot is something my trainer would really emphasize, where it's like, what is kind of the perfect spot where like it would be super, super ideal if a stock were to get there on the daily chart. And it's a good practice to look at different daily charts and just say like, okay, where would I really, really want stock? So if we take this chart where LASE has just been totally exploding higher, if we were to panic, the sweet spot for me is all the way back at this moving average. And notice that that's exactly where we panicked. So from a daily perspective, I really, really want to again, it doesn't mean it needs to stop there, but this is my dream spot for it to stop there. Of course, I want the intraday, being an intraday trader, to align with the daily chart. So now let's look what this intraday looked like. So this was the day. So the stock just absolutely starts melting off the open. Around 750 was where we break prior bar lows on the daily and just melt, 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 melt. We hold prior bar highs the whole time. We get to that sweet spot on the daily, and then we break to prior bar highs. And so this is the bar where you want to accumulate, and this is an awesome trade. And so this is funny because I'm actually working on this script today. So based on prior bars, I should be getting out below $5, right? Who wants to suggest why I don't think that's the right stop? Who wants to be brave?
I don't think we've really trended yet. So I don't think it makes sense to use prior bar lows in this case.
What else?
Is it
It's
kind
also
of
like really close to your entry rate. I mean, you could still be risking pretty much, whatever you were risking, and it's not, going to affect that much DEV. I mean, you can still wait for the trade to go in your favor, and it's going to be much more optimal in the future, I think.
Who else was speaking?
I think given how much shorts have been there, you could probably believe like there's probably a lot more shorts to cover, so the move could go higher. And you could risk that your initial entry given how extensive that move down, how much it capitulated down.
I like these thoughts. Does anyone else want to add something? I know we got a couple comments in the chat too. Good
can I hop
comments in
in
the chat.
really quick?
Yeah, hit me.
So maybe based on your testing, you have certain expectations for this type of trade. So if you have like a high conviction that it's going to meet those expectations, then potentially just holding based on that.
I like where that's going.
Does
So
that something to do with the massive volume that's coming in on that spike?
I mean, also interesting. So nobody quite said the magic I really want, which is, and I love this because this is literally the exact topic I'm writing about, is ultimately every decision really is driven by expected value. So the only reason I want to use a certain stop is if I think in that moment the expected value has gone negative. Actually, I might still have this drawing. Can you guys still see my whole screen or no?
Yes.
I did. Okay, I am doing holds. Let me see. It's not this one. Time out a sec. Let me see. Ah, yes. Can you guys see my beautiful drawing?
Yes.
Yes.
So I promise you guys, my shitty drawings will not make it into the course. And this is just, eventually like a video editor needs to obviously make graphics out of my dog shit, cocktail napkin drawings. But the point I want to make here is, and this is interesting because we just discussed that higher low, lower high concept. Let's say the stock really panicked down, and then we turn and I get in or something, right? So the question is, yes, we break prior bar lows here, but is the expected value negative? Like, because I don't want to just take prior bar lows just because it's prior bar lows. Like, I don't want to do anything blindly. The underarching principle or overarching under, I don't know what the saying is, whatever. The underlying principle is that I want to get out when the expected value turns negative, right? But the issue is my incremental risk to lows is really small here. That's what this gray thing is supposed to show. My incremental risk to down there is very low, but my incremental reward, should this bounce, is really big. The other thing is, given this pattern, this has the potential of that specific spot making a higher low. And so therefore, I'm not so certain that the odds of this going to lows is that good. Like, if this was a really good capitulation, I don't think this is just going to immediately go to lows. The other thing is, like, think about how much bigger this potential reward is versus that incremental risk. Like, this is easily like 7x the reward versus incremental risk. So a lot of times, if we're really close to here, I want to just give it the full stop to there, right? And so that's why this is such an incredibly timely example to then make this case, right? And so this just went to my sweet spot on the daily. We just melted in an enormous straight line. We went from like, $9 pre-market all the way down to sub 5. So selling at $5, like this is probably what, like a sub maybe like 20% retracement or so. And the other thing is people that wanted to buy, they barely had a chance. This whole move happened so quick, right? And let me see, I had something in the chat real quick. Yeah, yep. So yeah, and Kushal's right also about with NKD that I highlighted is like sometimes you really want to just give it to those lows because you think the expected value is still positive, right? And like I would argue there's no reason why this stock, like my base case is this gets to at least 550, if not $6 or even $7, right? Like it wouldn't be that crazy of a bounce to see 650. So I don't want to be so eager to sell there, especially when like we halted here, then this was just an unhalt, like it's been, it didn't even have like this full trading. So now look at this, like the next day, I think we do end up even going above 6. And the reality is we never spend any meaningful time below 5. And I think if you were to take this play and replay it over like 20 times, the odds of this rolling to lows, when that goes right to the sweet spot, like in the aggregate, you're going to be so much better off holding this. So that's times, as that document you saw, that script that I was working on, that's why it's called, when don't you want to listen to the proper stop, and like when do you want to call an audible? And so this is a great example of that, where we're just way too close to these lows, given how epic this move is for me to want to be getting out there. Does that make sense? Because this was actually like a really pertinent question.
Can I actually ask a follow-up question on that?
Hit me.
So, this is the decision is based on the EV of the trade at that given moment of time, correct?
Yep. Mm-hmm.
And so, at that time, I mean, you're basically, the roundabout answer is because you're basically close to entry, but the logic behind it is because the EV of what you're risking versus the EV of what you can gain, or what you're risking versus what you can gain basically makes it a positive EV situation. So you want to keep holding. But
Exactly.
As the trade moves kind of in your favor, it's starting to move, that EV is changing, right? So
Yep,
like,
100%.
so you're constantly evaluating after
Yes.
each bar or each step when you want to start applying the stop at the prior bar lows. Is that correct?
Yes. And that is why, somewhere in here, somewhere in there, there's a more or less, oh, wait, I think I'm right there. Expected value is always changing, right? And so I have that topic exact because it's so important, right? Like every single bar that happens is we need to be assessing, right? So I have this example here, which is, I believe this is the MSTR example. Yeah. So this was when MSTR had the, oh God, was it Kerrisdale? Who came out short on this? Was it Hindenburg? Yeah, it was Kerrisdale. Yeah. Kerrisdale came out short on MSTR, and I didn't, like, everyone knew all this stuff, but it's like I didn't necessarily think it was going to break. But I make the point in this eventual video that the report comes out here and we retrace all the way back. But then once we break those reaction lows, you can see my cursor, right, guys? I assume. Okay, good. Once we break those reaction lows, all of a sudden the odds have changed. When we then start to crack, then here, this is where we're breaking prior daily bar lows. So now we have a beautiful consolidation. The stock's already unwinding. The odds of this cracking right here is so different than right here when the stock is fully retraced. Like, okay, report came out, we came all the way back. Like, man, I'm not confident that this is going to work at all. Like, we're just sitting here. But once we start to crack and that snowball is starting to roll down the hill, this play can end up being amazing, even though this I had no view on whatsoever. So to your point, 100% yes. Like every single bar that develops, I need to be assessing that. And the closer we are to these lows, the generally higher the expected value. But as we start to bounce, let's say this started to then bounce up to like 850. My expected value at that point might not even be positive because we've bounced so much. So yeah, every single, like as this develops, I'm definitely figuring out like, okay, you know, what's the right stop? What do I want to see here? And if it's not trending super cleanly, there might be times where I just want to see, for example, higher highs and higher lows, you know, and then we kind of just sit in this range or whatever. And so like maybe eventually if we're just consolidating all day, like at this point, maybe I give it to $5 potentially. I wouldn't, but even then, I don't think it's probably worth it. The problem, man, this is just such a big move overall. So yeah, I don't know what probably would have been the right stop beyond lows. Like I'm probably just giving it to lows. Like even if later in the day we rolled over below 5 again, I don't think I'm raising my stop to $5. Like I think given this daily, and how aggressive that is, like, you know, this stock was strong for so many days to then melt. Like, I don't want to sell right here on the daily. Like $5 is just too close to this breakout level as well. You know, like if, like, I think I'm way more likely to be selling at 6 than I am at 4, you know? And like, if that's the case, like, yeah, you need to just reassess. Does that kind of make sense?
Yeah, and sorry, I just have one more question regarding
go for
this. Now, does it ever get to a situation or a point where, let's say the trade's moving in your favor and it's getting close to maybe a projected target, but you're not able to move necessarily the stop to a logical place, right? To where it makes sense. And now the EV of distance to your target versus where you have your trailing stop or whatever becomes negative. Do you ever just close the position out there because of that rather than—
Congratulations, you just hit on one of my case study examples for the course, which was this VIX example. So this was back in August or whatever. I shorted some VIX at the close here. The next day, like the next morning, we're all the way like over 10 points lower. The expected value is way different down here than it is up there. And guess what? Off the open, we end up all the way down in the low 60s. Sorry. Technically, my stop, if I'm swinging this, technically my stop is $30 higher. That's a crazy amount far away. And the reality is, even if this bar closes, even the next day, like the highs are still at 80 plus, an enormous distance away. So when this was in the low 60s, like sub 65, and even like probably around here, I started to take off like a very good amount of size. I didn't get totally flat, but I was way reduced because we've retraced so much of this move so sharply, and my stop otherwise is way up there. Then sure enough, what ended up happening was on this 8-6 day, the VIX really squeezed again into the close. Because I lightened up so much size, I was able to re-short a bunch again. Because like the amount of size I want at like 72 is way different than the size I want at 62. And so yes, I'm paying a ton of attention, and like I absolutely will pull an audible. Oops. Oh God. Here we go again, guys. Like, let's say, for example's sake, what if this opened at like $70 and this melted all the way down to 50? If that melts all the way down to 50, I'm not going to have a single share. And you want to know what happened? This ended up holding prior bar highs the whole way back to 45. Like, I mean, I didn't hold anything to here. I think I held like, I think I had like an embarrassingly small amount of my position like these days. Like, I think I ended up with like 10% or something. Like I only had like a just an embarrassingly small amount by the end of this, but that's okay because I don't think it's justified. Like I don't feel so, I don't know if it's like I definitely just don't feel strongly that the expected value is so good when it's done something like this. So maybe it did work out amazingly well, but like no way is that expected value as good as it is up here or up there or anything else. So yes, I'll definitely call an audible sometimes. Then the other thing too is like even take something like an Apple. Like this stock ended up bouncing even above where it was beforehand. So it's like even this Apple, like I didn't hold anything up to here. And I know technically my stop is prior bar lows. And in theory, you could have had like this epic hold. But like by the time we bounced all the way up here, like even in this bar, we were approaching a 100% retracement, but my stop is still like, you know, at 211-ish. So like I don't want to risk an extra 10 points because the odds of me making another 10 points are super low. So yeah, there's times where I'm just always trying to pay attention to what do I think the math is.
Okay, cool. And you'll make that decision sometimes even intra-bar as opposed to waiting for a candle close.
Yep. Now here's the one caveat, and it's funny because again, this is literally the scripts I'm working on today. So there's one major caveat. I think most beginner traders tend to place their stops pretty arbitrarily and they don't have a good system. So like the other thing too is I'm not sure a beginner trader or even an intermediate trader is super amazing at gauging like the expected value. And so if you're on the newer side, what I really urged with my trainees is I want to make their decision making as simple as possible. Trading is hard. There's a lot going on in real time. And so I would ask them like, hey guys, you're going to see me make the occasional audible. For you guys, I want you to just always follow the stop. If X happens, do Y. If A happens, do B. Why was I doing that? Because it still leads to a good enough outcome overall, but it simplifies their decision making. You know, they've got too much going on in their head. You know, imagine when you're first learning to drive a car, right? When you're 16 years old and you're getting on the highway and there's a zillion cars, like no one's telling you. Imagine telling a 16-year-old, hey, what you're going to do is you're going to shift over the 3 lanes. You're going to cut ahead of that car and you're going to go back into the fast lane. Then we're going to, you know, what you tell a new driver is, hey, find the lane that you're comfortable in. And we're just going to stay in that lane. And you're just going to be wary of the other people and their moves because you want to just simplify how hard it is. Right. And so for a beginning trader, I'll just tell them like, just do the traditional stop, keep it basic, and then just Evernote where you think an audible might have been a good idea and why, and start to track it over time. But most beginners, they harm themselves by making wrong audibles and not like, you know, they just want to have like all this pizzazz and like think they're doing something instead of following the system, which doesn't help them. So again, it kind of comes back to like where you are in your learning curve. Like if you know a stop works overall, and you haven't proven the ability to just follow the basics, you know, always start by following the basics. But for someone like myself, you know, like, so let's go back to that. Oh God, what was it? Lays, LASE. So there would be times where for the reasons I just explained to you, for the reasons I just explained to you, I am not going to be hitting out sub $5. But if my trainee buys this break of prior bar highs and sells right there, you want to know what I say to them? I say, good trade. You want to know what I say to them? If they pull an audible as a beginner, I say, bad trade. You did not do what you were supposed to do, right? And that's because I'm asking them to build up the reps, just following a very explicit stop and building their system. But for me, I know that, hey, yeah, overall, I never want to sell there. Again, because of oops, I lost it already. Because of this example here. that I pointed out. You know, like take, for example, the GOF, which I always love going back to. If you know, I have a trainee that buys here and then they get stopped out there, I tell them good trade. Me, I'm not getting stopped out here. I'm probably buying more onto this and eventually getting stopped. So here's actually, this is a great example, Sean, to your point. So here we're still pretty damn close to lows. So maybe I do still sell some here, but here on this bar, I'm potentially buying more. And certainly on this break, I might consider it as well. But then what happens is, look what happens. Now we start to hold prior bar lows, you know, 1 bar, 2 bar, 3 bar, 4 bar. So once we're doing that, I'm 100% going to be using that as a stop, right? So if this 11-1 bar, if this bar turned and we broke below 12, I'm probably getting out because it developed that way. Does that kind of make sense?
Yeah, it makes a lot of sense.
And like that's the hard part is like, you know, people want to reduce trading to just like super simplistic rules, but like it's a lot of this, it is nuanced, right? Like, you know, why am I giving, you know, prior bar lows here? Because the pattern developed it. But then there's going to be times, you know, where I might not, but there is logic, but it's just not super simple because these decisions are complex. But yeah, that's how that would unfold. Yeah. And honestly, even on this gap up, right? At this point, we've recovered so much of this down move, and that's a pretty big gap. To be honest, I'm even probably selling a chunk here anyways, because look how far away that stop is. That stop is so far away, and that's a big gap for this closed-end fund. So I'm probably selling a chunk here, and then once we break here, I'm definitely getting flat. So, yep. Let me move on from there for a bit. Alfonso, what advice would you give to someone passionate about trading but with a full-time job? It really depends the person's situation for this. Never ever risk more money than you should be. Like if you don't have proven edge, you shouldn't probably be risking real capital at all. I think people are too eager to risk money when they don't need to be, instead of using paper trading or just trading one share. And the biggest piece of advice is just going to be to recognize that the learning curve is longer. If you are not able to commit full-time focus, you can't expect it to be a 2-year learning curve. It's going to be longer. And this is actually one of the first videos I cover in Magnum Opus. And it says it's setting realistic expectations. The runway for this job needs to be very, very long. At some of these professional prop firms like SMB or Trillium, they're telling you it's a 2-year learning curve. It's a 2-year learning curve with close mentorship, with a trading pod, with firm technology, with firm resources. It's not your capital, and you have all this really, really good traders around you. You have the optimal environment and resources, and they're still telling you it's a 2-year learning curve. So if you don't have those, right? If you know, let's say you don't have a mentor, or let's say you don't have a good source to learn from, or let's say you have a part-time job, or let's say you have a full-time job and then you have 3 young kids. You know, if you have a full-time job and you're caring for 3 young kids, the learning curve could be 5 years, it could be 7 years, it could be 10 years. I don't really know, but my best advice is like, you need to set your expectations to be reasonable for your situation. And then what I would say is like, you need to play to your strengths. Like if you can't be glued to the screens every day, you don't need to be focused on super high-paced trading, super fast-paced trading. Maybe swing trading makes more sense. The other thing is I would just really try to make a little bit of progress each day and just enjoy the process. Like if you're not able to commit full time to this job, it is a brutal long-term commitment. And like frankly, that's the word. Like frankly, if you're doing this part-time, the odds are so stacked against you. And I don't mean to say that to be an asshole. It's just to be realistic and help you get the best outcome. If you're pursuing this job part-time, which decimates full-time, young, huge long runway traders with a lot of resources at these prop firms, like absolutely go for it, but enjoy the process. Like if you are setting all your expectations, oh my God, I'm going to make 50 grand by the end of year 2. I'm going to make 100 grand by the end of year 4. Like you're just not going to have a fun time. So like the way better approach is just say, look, I'm doing this as a hobby. And if I get good at it, amazing. I'm going to work really hard in these windows of time. But like I'm doing this as a hobby. I don't expect to earn money from it. If I end up good one day, great, but I'm doing this because I enjoy it. And that's really how I would approach it part-time. Like this is just a fun hobby I enjoy. And if I get great, okay, I'm going to then make that decision to commit more resources as it comes. But just getting better each day and not beating yourself up, and just committing the time you can and seeing where it goes. Let's see. So then Drew asked, have you ever incorporated order flow / volume profile into your trading? I think we have Drew on the call, and if he is, like, I understand order flow. I'm not like by volume profile, just does he mean how much volume is occurring? Oh, and nice. We had Afonso on the call, so I'm glad that was helpful. So yeah, Drew, if you're on here, I don't quite understand volume profile, but if volume profile means just simply, do I factor how much volume is going on? Like, absolutely. You know, that's why this GOF was so interesting. That's why, like, oh God, I misspelled it again. That's why this LASE panic was so interesting. And as far as like order flow and stuff, I'll definitely be watching the level 2 box and the Prince window to know how much volume is occurring. Are there any big sellers or anything, any big buyers? Are there any patterns to it? So if we take something like GME that one day that I posted on Twitter about, you know, this day after hours, there was an ARCA buyer that was just absolutely blowing up, and he was also there pre-market. So I'm definitely paying attention to that. Also regarding order flow, like there will be times where you can see a large offer on the book, and then he'll kind of, you know, this offer might be walking the stock down and going lower, 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 and the market's scared of him. Then sometimes they go market, and you see a huge print, and like, you know, let's say it's a 50,000 share offer, then you see a print where it says 500 lots. You know, 500 lots is 50,000 shares. So then you're like, oh, that seller's done. Then oftentimes that leads to a bounce. So yes, I'm always paying attention to large buyers and sellers and how they're kind of selling and if there's any patterns to it. And yes, I'm paying attention to volume profile, at least if I'm on the same page as you, where I do want to see like the capitulations having big volume. I do want to see breakouts having really big volume. Even news trading, I want to see large, steady volume on the really good news headlines. So I'm always paying attention to that. God, my voice is already starting to go. So let's see. So this was a good question by Abtahi, if I'm getting that right. Again, sorry, everyone. And I know you're on call, so my apologies. If a great trade usually moves in your favor, right? Yeah. So one of my heuristics is, you know, the best trades usually go right in your favor. His question is, do you cut if it's slow, and do you look to re-enter or let it play out until the stop and the target hits? And so this is a really good question. Like generally, it's a really good thing to think about. Like generally, rules that remain true, you can generally invert them. So if the best trades go in your favor, the worst trades tend to not. And so if something is really struggling to bounce, I definitely am more eager to take off and cut early. So let me go to this. Oh God, I keep on doing this. Trading's a game of not making the same mistakes. Then I just make the same mistakes in Thinkorswim every day. So the other interesting thing is, like, this was a decent gap up from that halt. And so let's say though that this stock turned and then we just started to loaf around here for a couple bars. For every bar that we're sitting down here, I do personally believe that the expected value is getting worse. And so if a trade is amazing, like I think this is a massive move and this was right to my sweet spot on the daily, because this trade was so good, I actually do want to give this the benefit of the doubt. And I do want to tend to hold even if we're loafing around. But let's say that this move only went to like $6.50 or $7 and it's not bouncing and it's really struggling. I will definitely consider starting to take some exposure off. So a lot of times what happens is if something's bouncing really well, I kind of want to generally hold on and let it bounce. But if something is struggling, I'm not afraid to start to cut. And like I would define struggling, like some people can hear that and they just get way too zoomed in and micro, where it's like, oh my God, this trade didn't work within 10 seconds, or this trade didn't work within 30 seconds or a minute. Like I would say, like, I would consider a trade struggling if we're spending like a couple bars and we're not going anywhere. So like, let's say there's some amazing $10 breakout and I buy, 20,000 shares at $10. If 6-8 minutes later or something, we're still at like $10.10 or $10.05 and we're not going anywhere, I might start to reduce, especially if the liquidity below 10 doesn't look so great. So as a general rule, I would say I agree with that. And you were saying from my data, I've noticed that A++ tends to show profit immediately. Yes, I think that's super common. However, when I cut early, there have been many trades where the trade eventually goes your way because of this. I usually let the trade. Yeah, and so that's a good point, is like at the end of the day, the best way to truly answer this is to just have data. And it's such an easy thing for you to test where it's like, okay, just take the 10 charts where it's off to a slow start. Like find the 10 charts or relevant data points where it's really struggling and just see how often does it go to those lows? How often do we end up bouncing more significantly? So there will be trades where it's like sometimes you do just want to give it some time. Like there might be a headline that you think is a big deal, but it's just not quite picking steam yet. Sometimes it just needs to, gain momentum and be rebroadcasted elsewhere, or it just takes time for people to start paying attention. So the best thing you can always do, of course, is to just collect the data and just see like, how do my best trades perform? How do these trades tend to pan out when they're not going right away? And if your data says that it's better to let the play trade out, you never want to let anyone tell you any differently. And a lot of what I'm doing with the course is I'm not really teaching in absolutes, but it's more so like, how do we find the right answer for us? And so often it needs to be two things. Like it needs to be driven by making the right expected value decision. Then ideally that decision is driven by the data for your specific trading. Also, 1 second, I'm just going to get some water, guys. It's a lot of talking. 1 sec. Me. Okay, we're good. Let's see. So yeah, let me know if that helped. But I think like you are thinking about that right. And what I would say is like, let me see. Let me go to this GL. This was April 11th. You got to do on demand. Ooh. Uh-oh. Did I just get the wrong day? What did I just do?
You're 1 year behind.
Yeah, thank you. Good eye. There we go. Okay. So, and this is one example too, where so this move was already really big, and then we turn and we bounce. And so like this is an example where if I'm buying 58s, I'm not probably selling right here for the points we just made, right? Like this stock was, I think, coming from like 100 on the day or something. Let me see. Let me zoom out for a sec. Yeah, we were coming from like over 100 pre-market. So to the point we were just talking about, like if I'm buying 58, I don't want to be so quick to hit at like 59, whatever. I'm probably just giving it to these lows. That being said, like this is not a good sign. It's not as if we just dip down, then we strongly bounce back. Like this is 1, 2, 3, 4, like think about like when a boxer is down for the count, like 1, 2, 3, we're spending 4 bars down there. That is a lot of time. That's 8 minutes that everyone's just chilling. So like, and I actually, if memory serves correct, I do think I bought here. I do think I held through here, but as a result of holding through here, I was way, way, way quicker to start to sell into this area because that's just such a bad sign. And especially once this bar failed, where we get above these highs and then we go back below, like I was definitely really starting to worry. And then once this starts to like roll over again, this is a very bad sign. So you want to listen to the data, but like, at least for me, I'm definitely probably starting to lighten up in here. And maybe I give some to the true stop. But yeah, long story short, in general, I think it's a good idea, but trust your data. Okay. Wow, there were so many questions. Holy crap. I got to get through some of these way quicker so we can get to everyone, or else everyone's going to be here forever. Wheeler on 9-5. I got to turn this off. I want to know your opinion on the mean reversion trade. Was this worth a given try, or was it not a quality setup? In real time, I thought it was, but I was actually surprised when it actually closed above VWAP and then drifted higher in the after hours. This strong PA price action made me think maybe this was not as good as I had thought. So immediately right off the bat, my 1 second assessment for this is like, I'm always wary of shorting these things on day one. Like this is doing insane epic volume. Like, like look at this yearly chart. I mean, obviously these are way higher prices and now it's at like, near zero. But this is an insane amount of volume. So my general eagerness to be shorting this is pretty low. Because the other thing you need to keep in mind is like, everybody holding the stock, and this is important. This is like the psychology of holders. This stock used to be at $600 or whatever, $500, $400, $300, $200. Anyone holding the stock when it's down at $1 from any of these prices, you're already holding a 99.9% down stock, right? If this stock goes from $1 to $2 to $5, it's totally irrelevant for you, right? Like you're going from down 99.9 to 99.8. Like nobody wakes up and sees their brokerage account when they have a $500 cost basis and goes, oh my God, we went to $2. Like, oh my God, thank God, and sells. Like you literally just held the bag for 498 points. Like you making the extra point is just totally irrelevant to whatever prior shitty decisions you made. And so when you get stuff where it's like, it has been up a lot prior, like, like think about it this way. This is early September. Like, just a couple months ago, we were 10, 15, 20, 25, 30. So like I am pretty reticent to short day one on that. So that's my short answer because I am way behind on these. So then Chuk Lao asked, can you talk about the procedure of analyzing the stocks you will be trading for the day? What you will look for at first and how to decide which playbook to play with? So this I actually already have a video on. If you scroll back to the beginning of the Patreon, I have something like my 5 methods for spotting opportunities, my 5 methods or something. And I discuss how I build the watch list and why, and how I find the stocks that I'm trading. So definitely go through that. Jamie asks, could you speak a little bit about the closing session / time of day and the importance of how a stock closes on one day with regards to its price action the following day? What information, if any, is important to consider when it comes to how a stock closed? So I do view the closing print as not just the closing print, but the closing of any bar as important, right? So we talked about stuff like, I think we talked about this, or maybe it's coming up in the upcoming video, but we've had similar examples, right? Like I think last month we talked about like Sirius, for example, where this has a blow off and it closes super weak, and then shorting that as a lower high. So the close of any bar I view as information, right? If this stock was so like if this stock were to close top tick, I'd be scared. That's a lot of strength and momentum to hold it up there. I'm way more short bearish biased the lower this goes. So if this closed all the way down here, at like 35, I know this had some type of reverse split, but a 10 for 1. But if this closed at $3.50, like I'm so more eager to short that gap. So yeah, these are very important to me. Like take for example, I don't know, like what else? There's been some other ones, but yeah, I'll definitely be doing that for some of those lower high things. Like I think I am making a video on this where like this Sava blew off and then kind of broke down into the close, then we gap up. So yeah, I'm definitely weighing that as an important tell overall. And thank you, Dominic. I don't know if the prior question is in attendance, but Dominic just linked that. Oh, it was my 4 methods. Man, I really swear that was 5, but that was a while ago. Anywho, thank you, Dominic. So now Roberto in attendance, he asked, how are you? Oh, well, I guess that wasn't the question, but well, I'm good, thank you. Very kind. My question for this AMA was, I decided to make breaking news my trading business, the best tools. How can I maximize the value that this tool offers for optimizing? So generally, and I'll need to get to this at some point more formally, but like no matter what, so there's 2 types of news services generally. There's the aggregators, like hold on a sec. There are the aggregators like Trade the News or Briefing.com or Hammerstone or I don't know. There's like
NewsEdge, for example, as well.
Which one you said?
NewsEdge.
NewsEdge. Yep. So NewsEdge, I'd say I'd view a little differently because they have direct APIs, but more like the Squawk services. So the Squawk services are always kind of running after the fact, but then you have the direct news sources like Bloomberg, Reuters, Dow Jones. Like NewsEdge has APIs that are directly pulling from the news sources. And so all the direct news sources, inevitably what you need to do is you need to create these queries or like these filters for how you're going to pull the news. And so like what you want to do is you want to observe what headlines moved different tickers and then reverse engineer how to filter for those. So if you have Bloomberg, for example, you want to find like what headlines moved the stock, what are all the keywords or the key topics or whatever that would then allow me to filter for it. Then you just eventually just tweak these filters over time. And I think I posted one on Patreon a while ago, but inevitably what you do is you say, I want to include A, B, C, and D. Then to filter the noise, you also say, I want to exclude X, Y, and Z. And a lot of using these news sources optimally ends up getting these really, really precise filters that you refine over time. And it also then comes from setting like sound alerts or color highlights and stuff to then help you be on top of them as possible. Let me see. I know there were some replies on here. Yep. So then like you'll want to do the Launchpad filters for Bloomberg. And so that's going to be the fastest way. Like for Bloomberg, at least you want that Launchpad filter and you're just refining. And like, so then, I would have one filter just for hot headlines, like one alone. I would just have hot headlines because those are super rare. Then I would have a separate filter that would have, some type of like heads, heads is the keyword for just general headlines. So it would be like heads and A, B, C, D, E, F, G, and you just refine it for like infinity. And you figure out, oh, why did I miss this headline? Why was it not in there? Or why was it? And so that's the path you want to go by. And it's a very iterative process. Like refining these filters just takes many months. And inevitably, you're still going to miss some stuff because it's a trade-off between noise and precision. Like if you have 5,000 headlines per minute, it's going to be too noisy and useless. So you want to find the right level of noisiness where you're not just getting too much slop, but then you're also not missing too much. So it's like a long process of tweaking, and that's part of the moat and work needed for that. And yes, Mark, Benzinga is another good news aggregator / Squawk. Does that kind of make sense for that, Roberto?
That's gold. Thank you. Thank you.
And that's something I'm going to touch more on over time, but that ends up fairly niche and detailed. But that's also on my list. As you saw, the endless list on the table of contents that will be touched eventually, though. And I think from way back in the beginning of my Patreon, there might be a couple more resources on that. I think I did back in the day. Yeah. So then Michael asked, during the time you were trading full-time, percentage-wise, how much of your P&L came from each setup? And he references breaking news, order flow, mean reversion, breakouts, capitulations, imbals. So what I would say is like, it actually really depends the year, because some years are very just price action focused, where you get like a lot of crazy panics. Some years are very breaking news focused. Some years are very IPO focused. Some years you have amazing imbalances and order flows. Some years you have almost none of it. So if I had to guess over time, oh man, maybe breaking news was like 15 to 20%. Maybe like some of the big picture price action panic stuff was like 30, 40%. Maybe breakouts was like 5 to 10%. Maybe IPOs were 5 to 10%. Maybe like order flow stuff was like 10%. And it's kind of hard to say. And obviously there's times where stuff just falls in more than one category. But I would assume like however you want to classify the crazy GME and AMC panics, like that's definitely been some of the biggest P&L for me. And like, especially nowadays, I'm not really trading breaking news. So nowadays it's definitely just the crazy price action panics, like that big market capitulation, like the GME AMC craziness. But I used to, and also not mentioned in there was scalping. So scalping, like, inevitably you're never going to scalp like millions and millions of dollars a year. It's just kind of liquidity constrained. But I would say every year I was scalping at least a couple $100,000. So you don't want to sleep on that either. So maybe scalping was 5%. Yeah. So I don't know. It's hard to say. But that's my best answer. Now, a really good question was, where did you compile your news / symbol notes? Directly in the chart or, Word, Evernote, whatever. So our software had a place to do that. I do know some software has that. I'm not super well versed in like different retail software. I do know some charting programs allow you to take notes as well. And obviously you can link your charts to the software. So what I would say is like, in an ideal world, you want just whatever is the most accessible and practical for you. Like, I think let's put it this way. If you have 472 Word documents, like that's probably not a good idea. If you have one Word document that's 900 pages, that's probably not a good idea. Just because it's not feasible to get you the information you need. So like, just off my head, if your software doesn't offer that, and again, I do think most of the retail offerings do, but if your software doesn't, like, I would just be taking it on the chart if possible, just so that stays kind of up to date and in your face. So yeah, it's just something that's just most easily accessible, and you don't need to sift like through a million pages. Imagine taking like physical notes you would just be like, going through 5,000 pages. It would never work. Then if you spill your coffee, it's game over and you ruin your life. So Ace, that's a power name, if in fact his real name. Can you talk about the velocity of price movement for example, I'll see a nice steady slow downtrend on the 1 minute candle, and then it will very rapidly jump up. What are your thoughts on that type of price action? You know, let's go to the handy dandy table of contents. And we're going to jump to the, oops, that's not what I wanted. Oops, gotta go up. Oops, that's not what I wanted. Rate of, there it is. Oh, what's this video called? Rate of change is everything. What do you know? The exact topic. So that's why I'm so excited for to be done with this course, is I can just so easily just throw people to the right video to answer so many questions in very high quality format. But that video exists because rate of change is indeed everything. And what I talk about in this video, and this actually came up last month in the Sirius chart, and it came up again, maybe, or that was last month, or no, in this month's review. So let me go to 8:15 and 8:16. Actually, you know what? Oops. Rate of change is everything. Let me see if I have it in here. Okay. So look at this AVGO chart. And this chart was from May 26, 2023. And this made a massive, massive move, especially for semiconductors before, like, it was common for semiconductors to move so much. AVGO went up 10% and 0 pullbacks. Like, that is an incredible move. But look how steady it was. And I make the point in this future video. Well, this one was actually recorded already, I think. But anywho, there's no reason to be shorting this because it's just so steady. We're just steadily holding the moving average. We're never above the Bollinger Band. So I never want to be taking the other side of this. Then look what happened to AVGO the next day. Oh, I don't have it. Interesting. Anywho, but then this is ASTS on the chart I was talking about. Look how steadily ASTS was going this one day. It's never far from the moving average. We're never above the upper Bollinger. But then, in some video I have the follow-ups. I'm somewhat confused on that one. So this 8-16, let me go to this. 8-15, 8-16. So on the 15th, we get this steady move. We're never above the upper Bollinger, and the rate of change isn't that crazy. We're just moving all day. Now, this isn't so crazy either, but it's a much sharper move than we were on the prior day. And so this rate of change to me is everything. And what I talk about is I never want to short anything with the slope of 1. Anything that's going like this or like that, like -1, I never want to fight. That's a totally sustainable move. What I do want to fight is when things go, and this was a fun word to pronounce on screen, asymptotic. You know, like for all the math majors and mathematicians, it's when it really waterfalls and goes straight down, right? And so I want to find the stocks that are going like boop and the stocks that are going like boop, not the ones that are doing this or that. And so to the original question, yes, like that is a really good observation. And I will never, ever try to fade a steady price. Now, vice versa, if I'm holding something long and we're just steadily going up at a slope of 1, I have no reason to sell that. As long as we're holding that trend, like if I go back to that AVGO example, if we're just holding the moving average all day, that can go forever. I have no reason to sell it. So yes, the rate of change is everything. That's what really kind of defines whether a move is sustainable or not. So Thomas was asking about data logging and deriving expected value from it. I'm a bit lost as I want to log so many data points for each trade, meaning I make columns for all these variables. Was it consolidating? Where? How long? How is the sector? the thing is like, so my goal would be to have each variable then play a part in the EV formula. So the next time a similar setup presents itself, I know if certain conditions are met. What's your take on this? Can I overdo it? That's a really interesting, good question. For like, essentially what he's trying to do is build a spreadsheet with a zillion variables and rate each trade. And hold on. So intellectually, I 100% understand what you're doing, but I do think this method actually has a bunch of flaws. And the flaw with doing this is that a lot of different plays have different variables of importance. And what might be totally irrelevant in one play could be totally relevant for another play. So I mean, as a very basic example, like take an IPO. An IPO has no daily chart. The daily won't be relevant. There's going to be trades where the daily chart is highly relevant. Then there's going to be charts where the daily chart isn't relevant at all. There's going to be stuff where it's like, you know, how long was the consolidation? Well, it's like, then it starts to kind of just intermix with all these things. Like there can be a play that's super, super amazing because of one variable, but then it could just be totally a zero in other areas. So I do think that like, while I understand what you're trying to do with this, I do think it can get kind of ugly in practice. And I think if you're going to do it this way, you need to like, I would not try and find some overarching formula, but what I would try to be as specific as possible. So I would say like, okay, I'm going to do this for intraday breakouts, that have news or something. And then I would say, okay, like how much does short float matter? How much does the float matter? How much does the length of consolidation? You could try it that way, but I would not be commingling or making this too broad because it just really matters the play. But I'm kind of curious what you come up with, but I have tried stuff like this before and I did find it not to work so well for me just because a lot depends on the play itself. And I think the much better approach is just trying to have a framework for understanding price action and like, you know, it's just like you can have so many good traders with different strengths and skill sets. You can have so many good athletes with different variables. And like you can have so many breakouts that like a breakout could be very, very good because of the level 2 box, but awful in some other areas and like vice versa. So it's just like there's just so many different ways to have a good setup. So I think it's just not a universal weighting, I guess is kind of what I'm saying. Wow, by some miracle, we got through all those questions on there. So now I can focus more on you guys. So let me catch the chat for a second because I think I'm somewhat behind on here. Okay. So one initial question from BK was, do you have any thoughts on trades off the open related to news? Headlines that occur overnight or pre-market, but there isn't pre-market liquidity for big holders to transact before the open. Did you ever explore any trades like this? And if so, are there any nuances that you think are important? So one thing that I will say relevant to this question is like, if a stock hasn't had the ability to trade meaningful volume yet, I will be very, very careful. I'll be very, very wary of thinking a stock is in the right spot. Like it's totally normal. You want to know a good example that came up with someone, this CrowdStrike. You know, this CrowdStrike had earnings on 8-29. So let me jump to that real quick. Bear with me. I need like a Vanna White that just magically has all my charts queued up while I stall and say funny things. Okay, here we go. So this CrowdStrike had earnings and like pre-market, the volume going off is extremely small. Like we're talking about 100 shares, 200 shares, 2,000 shares, 1,000 shares, 1,000 shares. So the volume going off pre-market in this CrowdStrike after it had earnings is just totally irrelevant. Like this is a rounding error. Like in this first bar, we end up doing almost 500,000 shares. Like the whole pre-market volume is like nothing. It's probably not even like 50,000. So the point being is like, I will not necessarily assume that 262 is the right price. Like this stock, oh God, my voice. Like this stock hasn't even had the ability to trade yet. So like when this shoots up like that, it's not so super surprising to me just because again, it hasn't really had the ability to transact. So my first implication is generally I'll be pretty wary of stuff with news that hasn't printed or done meaningful volume pre-market because you just don't really know what the right price should be. So did I ever explore trades like this? And if so, are there nuances? Like I never found some great, like, unless I had a view on the news itself, like I was really, really good at M&A news. So there would be times where I would have a view on how much that headline should cause the stock to be up. So there might be a headline and according to me and my framework, it should be up 10%. So if the stock was up, 3 or 4%, I might potentially buy that and do a very just mathematically based system and ignore the chart. So that's one way. Another thing I used to do is for S&P addition deletions, like when stocks get added or removed from the S&P 400, 500, 600, I would keep really good data on how much these stocks tend to be up in the aggregate. So there would be times when I would have a mathematical view based on the data points and some other stuff. So generally, that is how I would do some of that. I didn't do a ton of it. And overall, though, I found like I wasn't so great at knowing like, oh my God, because this stock had theoretically good news, it's gonna explode over the open. So I don't have any major thoughts, I guess, beyond that, other than like if something hasn't had the chance to trade yet, there hasn't been meaningful price discovery. So let's see. I'm going to jump towards the bottom of the chat. It's going to be hard for me to get to some of those paths. Let me see. So Rajan asked, do you have any more detailed write-ups? I found the few you posted really helpful. I'll have to look through my Evernote. Like, I'm sure I do. That the hard part is honestly, like I have a zillion Evernotes, but it's also a matter of just like making this presentable for people to understand well. Like a lot of times if I just like chicken scratch a chart and paint, like I kind of like so often at this point, if you show me one of my charts, I know exactly what I'm supposed to be looking at and what I'm supposed to be learning from the chart. So like to some degree, a lot is just like, I just know what I'm supposed to be paying attention to. And generally preparing these write-ups requires me to put in like, for mass consumption, I need to end up like revising, polishing, and everything else. So I'll look at some point, but that's the main constraint. Like, do they exist? Yes, but are they like easily consumed by people? Like, maybe not. The other thing that's also kind of tough, to be honest, is like some of my charts in my Evernote do have my executions. And it's not that I care if people see my executions. Like, I'm not trying to hide anything. Like, the bigger issue is a lot of times my executions confuse people just because it's like, you can't tell how much size any execution was for, nor you can see my rationale. So like, generally I don't post executions. And then when I did like the AMC GME executions, I think that's the only one I've done execs for. Then people were like, I don't get it. Like, I don't understand why are you not shorting the right side of the V, or why are you not doing this very simplistic basic thing? And it's like, well, like that's the issue is like, it's more confusing and more harm if I'm not there to like really deeply explain it. But I'll see if I can get some really, if there's any notable ones, I'll take a look, or maybe I'll get my assistant to just scan through and find some cool ones. I'm sure they exist, especially for probably there was like my daily report cards only started formally in like 2018, and I assume I have some pretty good write-ups before then. The other thing too that gets confusing for people, and which I think is actually the coolest part about the daily report card and stuff, is obviously myself as a trader, I've evolved so much over time. And so especially when I post some earlier stuff, like I might be doing stuff that like I don't necessarily agree with now, or like stuff that I didn't yet learn yet. So there were times for like, probably for the first 5, 6, 7 years of my career, there was a lot of times when I was fighting on the left side of the V, and doing stuff like that, which then, people get even more, it just, makes a mess. But yeah, I hear you. I'll take a look. So 7-29 on this Beyond trade. You mentioned the trade being on the backside, but we hadn't yet turned yet on the daily. So generally, so this raises the question of how does one define the backside versus the front side? So in true form, like I would say there's a backside on the daily, then there's also a backside on the intraday. The best trades happen when the intraday and the daily are aligning and they both become backside, right? When they're both breaking and they're both cracking. And so that being said, though, you can get stuff like this Sava is going to be the perfect example. Watch this. So so with this Sava is going from $12 all the way up to the mid 40s. So technically for this daily chart to be backside, I would want to see, this to probably break $25 technically if I was just totally ignoring the intraday. But now let's look what happens on this 8-5, and it goes to the close, that someone else had asked about and how deep we cracked. So this 8-5. So keep in mind, this day was very capitulatory, like huge price range, huge volume. So now 1 second, got a Vanna White myself. Okay. So this stock kind of breaks out. We hold above the moving average pretty much most of the day. I would argue like this is one turn and this might be cracking, but we're still holding, kind of the higher lows here. Like I would say like this, this was a move like, higher low, higher high, higher low, yada, yada, yada. We make this move here. So higher low, higher high, or sorry, oops, I said that backwards. Higher high, higher low, higher high. We don't pull back at all, higher high. Like, so here, what I really would have wanted is if this broke below this range, like call it 34-ish, if this ended up rolling over and breaking this, I would say this is backside intraday. What happened here is once this cracks through here and we start down here, like I would say this, anything sub 39 is backside intraday. That doesn't mean it can't just reclaim and work anyways. But I would say this is all backside here on the intraday. Then, even though we're not technically the backside on the daily, what that does is keep in mind, we cracked from 42 all the way down to 34. That's a massive move, right? Right at the close. So what that does for me is even though technically we haven't broken prior bar lows, because that was so capitulatory with the price and the volume, when we cracked so hard, I still consider this backside where I'm willing to short this. I'm willing to short this against those highs. And so I don't have this pulled up right now, this Beyond trade, but that I'm hoping it answers it. But I don't have the DRC pulled up right now. And I guess I could, but I don't want to stop and have everyone waiting on me. But those are some times where I might use like a trend line or whatever else. And like once the intraday cracks and like it's like, wow, it's one of those just, death candles where it's a mess. That's when I kind of consider like, okay, we've gone backside on the intraday.
Yeah, that makes more sense, Lance. Thank you.
Yep. Then I know I missed a bunch of other questions. So hold on, let me see what I missed. Maybe I didn't. Lior asked, can you give 1 or 2 examples of current SMBs, traders, easy money trades that are repeatable / replicable? I mean, it really depends the trader, like, and I don't know like all of their trading super closely. What's a good example? You know, they'll do like just certain momentum stuff, stocks that close really strong with momentum and breaking news. Like for what was that one ticker we did? What was that one ticker someone asked about that was like super beat down, and I said you got to be careful. Where it was like day one and it kind of reclaimed.
Was it?
Wheeler?
Yeah, WHLX.
Well, Wheeler, thanks whoever said that. Yeah. You know, like so there'll be some people that like really like kind of like the overnight longs. Like this almost somewhat reminds me of the MULN trade that I've written up before, where it's like day one super beaten down. This didn't close that strong, but this almost reminds me of like MULN and FFIE, where like so some people will do kind of like, you know, just some overnight momentum stuff. Some people are just really good at scalping and they'll do scalps like I was describing earlier on this call. Some people are good at imbalances. Some people are good at, I mean, Swing is someone that's just kind of scalping all day. Some people like that bouncy ball setup where you kind of have a support level, you make a leg, then you have kind of lower highs and then you break. You know, there's people that will do that. So yeah, those are a couple examples, but it really depends on the trader. I mean, there's just some traders that are very data driven, and so they will just have data that supports, okay, in this type of pattern, I'm going to be long based on this stop. Like a lot of the guys there tend to like earnings as well. Like I tend to not trade like day one earnings tickers so much, but they tend to like some of that. So it's you know, it's such a heterogeneous group of traders that it's like it's hard for me to stereotype, I guess. Let's see. So Carl, do you have any opinion? Oh yeah, that ride was interesting. So yeah, I mean, oh God, my voice. So let's see. So this ride obviously does fall into the category of dangerous and, you know, primed for potential liquidation. Hasn't been around that long. Big run up. This ends up cracking. And actually, let me pull this up. I don't know any opinion about. So I don't know whether Carl was referencing the short or the long, but I actually thought the long was an amazing opportunity and is going to be written up. Oh, so Carl was talking about both. Yeah. So let me go to this. There we go. I think we started to crack right before the close. Yeah. So obviously, like we got the massive volume exchange. Like we've talked about so many of these liquidations before, and like, are they worth going for? Are they not? Can you get ZJYL squeezed? Like, I don't know. I don't have some super strong opinion on whether these are super smart to go for or super dumb. I think you do need to be somewhat cautious after ZJYL and everything else. I mean, that being said, this is doing some insane volume on this. Like this is, I mean, that's a crazy amount of volume to get exchanged there. So I don't want to go out on the limb and be like, oh my God, you should definitely be shorting this stuff. Cause then if someone blows up, it's, you don't feel great about it. So I do think you need to make your own personal decision, whether you want to participate in these liquidation plays on the short side. You do of course want to be cautious where you buy into these because a lot of these retrace super massive. What I will say though that happens is, so on this yearly, like the range generally is like $2 to $11. So yes, I get that this totally epically imploded, yada yada. But now what I want to point out is this day. Like we're in this kind of $3 range, which is just obliterated versus where it was. We kind of break down hard, like volume's really coming in. We halt like this open at 76 cents, like that is such an epic move. Like the probability of this bouncing super meaningfully from here is like amazing. So I think out of the whole saga, like this was the holy shit, like probability of a bounce, like nearly 100%. This was, I love this one. Just because, you know, we spent the whole day at $3. Like the, you know, the liquidation's kind of already happened. Like we're already down in a range for hours. And again, your risk is just so defined here where it's like, where should this thing go? It's like think about it. This ended up bouncing a $1.50-ish, a $1.25, an easy double. Like for every time this happens, this isn't magically going to zero. Even if this play fails, like in a worst case, you're probably getting out, like if it settles down here at like 60 or 50 cents, like the odds of you losing 75 cents is zero. Not zero, but nearly zero. So the odds are so skewed in your favor on this play. So I thought that part was good. Yeah. One second, Roberto. Can I please go over Oracle on 9:13? I'd like to know if there were any setups for you. Oracle. Did I read that right? Yeah, Oracle 9-.
Oracle was tricky because without that guidance after hours, it was that classic exhaustion gap.
That's a big move. Yeah, I mean, so this had the whole earnings after hours. Then we essentially just faded the crap out of it. So one way I'll look at this stuff and like, boy, oh boy, did that really shoot, my God. I mean, in general, like, did this make an enormous, super clean move? Yes, but God, I don't know if there's anything I would do here because generally what I would want is I would have wanted some type of setup off the open, whereas just from the opening print is totally paired. And like what I would say is like that's an enormous move. I mean, my God. What was this gap here?
Earnings.
What was this one then?
Guidance that they guided higher.
Oh, this was, that was a guidance up to, wow.
After hours.
On September 10th, and then the big gap up was the guidance update like 3 days later or something like that.
Wow, geez, that's super fascinating.
So it's highly unusual that you have a guidance update that close.
Yeah, that close to it. And it's like, wow. I mean, so I would need to, so did they release any guidance on the earnings at all or no?
I don't remember.
Wow, so interesting.
I think they did. I think they did because we studied that on at SMB.
Got it. So yeah, my first question is like I'd want to look back. I mean, I'm not gonna speak without knowing. So like my first thing that I would be doing here is I would be looking to see whether some form of initial guidance came out. Because if there was some initial guidance, it's like, wow, what the hell changed in just a couple days? Like, yes, highly abnormal.
I think they talked about some relationship with Microsoft with Oracle being the back end for some of their AI stuff. If I remember
interesting.
Correctly.
So maybe this was like an additional just AI hype gap and all that. Yeah, super fascinating. I mean, like I do know some guys that are super good as far as just feel for this stuff. Cause like that, I mean, overall for Oracle, this is a massive move, right? For us to go to 140 all the way up to there, that is pretty impressive, especially like I would definitely be looking into whether they gave any type of guidance prior. Cause that's that's a massive move for just a guidance update. Generally what I will say is like, you will get times where I know this was on news clearly, but you will get times where the news itself can be somewhat exhaustive. And it's not uncommon for you to get that opening print, then boom, the thing just melts. That being said, so this was a 5-year guidance, Brock is saying. Wow. I mean, that's pretty amazing. What I would say overall though, because at the end of the day, I'm just not perfectly prepped for this question. A lot of times when you gap up that far after such a move, a lot of times these moves can get faded off that opening print. What I would say though is when we don't have a trading range established, I personally find it very hard to capture these. Like there might be times that I have a view where, oh my God, this gap is just way too big. It's going to get faded. I'm trying to think of some recent examples. I feel like there were a couple earlier in the year. Was it the Mara at the beginning of the year that kind of had, that was where we failed. No, that wasn't a gap. Moral of the story though, when we don't have a trading range off the open, I personally find these somewhat hard to capture. So there's times where I might have a view, but like what I really would have loved is I would have loved if this was the opening bar here. So what I really like is where this can be the opening bar, you get a little drive off the open, you kind of get your little pop. Then it starts to just top and then grind. And what I would be looking for is if the open was 172, I would be looking for that crossover. And so that's like, generally I want some level to work off of. And so what that does is if you get, again, I recognize this is not the opening print, but I'm just saying hypothetically, if 172 and this bar was the opening print, I love when you get that opening drive, then it crosses over and cracks. Then what I would do generally is my stop would either be I would be short 172, giving it to highs, or sometimes in stuff like this, you can even just be okay giving it the prior bar highs. Like this actually, what I'm describing isn't so different from what I was talking about in ASTS on this 8-16. Let me pull that up real quick. Boop, boop, boop. Where you get, and this is even a more prolonged one, but what I really like is, let's say, for example, we did the couple bars here, then this started to fail and cross over. I really like where you get that opening drive, it fails, then it cracks. So yeah, that's pretty damn impressive though for Oracle. But otherwise, yeah, I find it hard. One thing I don't want to do is some people might just be tempted to hop on the trend. Like, even though this ends up working for a while, I'll never chase something and just short like 170 or 171 or 169. It's just too sloppy. Like what I do generally need is just some form of clear setup. So despite the massive move, I probably would not have done much here unless I had the view like, wait a second, why the hell is this doing such a crazy gap when we already had the earnings? But yeah, highly, highly, highly unusual for that to happen. Any other questions on Oracle based on that? Yeah, hit me, Roberto.
No,
Thanks,
not about
Dominic, for the help with that one.
but not about Oracle.
Hit me.
Something else that I think it's going to add value to the entire group. Let's go back to Delta Juliet Tango. As you could tell, I was very aware of the context. Once the headline came out, I understood the implications of that piece of information right away in nanoseconds. I have a very robust system for taking advantage of these scenarios. My entry was, a sniper shot every single.
Whoa. No sniper shot analogies on this one, Roberto.
Oh, yeah. I knew about that second attempt on Trump.
Was there, I saw there were shots by the golf course that he was at.
Yeah.
Was it his second attempt?
It's considered by the FBI as a second attempt.
Wow, holy shit, that's crazy.
Yeah.
Wow.
So I was very aware that for me, this headline had an insane, the highest EV you can get.
Yeah, super good. Yeah.
Like this, giving the context, and I only put 10% of my daily stop on this one. So my question is this one, Lance. Back in the day, even before that Tesla exhaustion gap trade that you took, how did you overcome that fear of the big numbers and start to reach that elite piano levels? And you know, how did you tell yourself like, okay, my playbook is ready. It's let's go time.
Yep. I mean, so first of all, like sizing in fast breaking news headlines is one of the hardest skills there is because you need to process, execute, and like recognize all these things and get the size just insanely fast. It's by far the hardest thing to do. So generally what I recommend people do is like you want to size up generally the slower, like this was a home run opportunity as you describe it, right? But oftentimes to build that sizing muscle, it's way easier to do so in the slower moving trades. So I think building that in the slower moving trades, and then you just try and do it gradually. And like, yeah, obviously, like this was an amazing opportunity. And like, I would, like, the point isn't, oh my God, I should have risked 50% or 100. Like, I guess, let me ask you this. Was it that you were afraid to risk more, or was it just a processing constraint? My guess is in this case, it often tends to be just processing with speed, or was it something different?
Pure fear. Because I have like plus 200 reps in breaking news already. And I have all my filters.
Well, so what was the fear? Fear of what?
What if this is not the scenario that I'm you know,
well,
I'm
so what happens? What happens if you're wrong?
I don't know. I lost. Maybe I'm not willing to lose 4 or 5 figures, but my system is.
It's like,
My
so
mind is not.
the thing is though, is like it's at the end of the day, you can always hit the bids, right? And so a lot of times we want to quantify like what our fear actually was. And it's like, okay, I don't know what size you traded. I don't know what your stop is. I don't know all these things. But like, in no way is that headline going to be a bad headline, pretty much, right? Within any reasonable doubt, like 99 out of 100 times, that's at least going to go somewhere. And so even if it somehow ends up being a non-event, like say, for example, this was widely known and people already knew that for some reason, he had said it elsewhere, like even if that ends up a non-event, at a worst case, like you're probably not getting out worse than $16, right? Like, and so then like a lot of times you want to quantify it and figure out like, what was my actual risk? What am I afraid of? And a lot of times it's like, you then want to try and size these the best you can and ask yourself, like, what is my risk? And so sometimes, and like, I don't generally always recommend this, but like if you can in real time, you want to be as conscious of assuming sizing is your number one thing you want to work on. Like if it's not your number one thing, who cares? You know, like, and that's the point of a daily report card, right? We want to focus on one thing at a time. If sizing happens to be like your number one constraint, then what you want to do is you want to build that consciousness in real time, ideally in your slower plays. And then eventually, once you start to train this, every single trade, you're like, what's my sizing? What's my sizing? What's my sizing? You can start to catch yourself in the fast ones. So even in something like a breaking news headline, you're able to quickly, and it doesn't need to be precise, right? If you're buying $17 and, you know, you can say, okay, I'm risking probably a point. I want to have, you know, $10,000 of risk. I need 10,000 shares. And you can start to do that in real time over time. And, you know, it doesn't mean immediately on your first rep, you're able to connect the dots. But like the first win is if that thought crosses your mind in a breaking news trade, that's a win. And maybe if the first 10 times, all you can do is the thought crossed my mind. Then, like now, of course, you want to carry that out, right? Maybe you don't realize that you should have more size until $18 and you're not comfortable adding there. That's fine. But over time, as you get more and more reps, this starts to move more and more faster in your head. And then it starts to become a second nature feel. And the other thing too, is when you do this in good spots like this, you get positive feedback. So generally, if you're applying this in the right places, it works out really, really well. And so eventually what happens is everything just ends up on instinct, where when you see some headline, when you get enough reps, because 200 might seem like a lot, but it's not, right? Like, over time, I mean, how many headlines have I seen and traded? Thousands, right? And so eventually you build that instinct where it all happens so quick in your head, where as you're reading the headline, you're like, holy shit, this is such a big deal. And your only thought is, I want as much of this as possible, right? And like, it takes a long time, especially in this category, just because it's so fast moving. So like what you're describing is extremely, extremely common. Again, like I opened this with, this is some of the hardest stuff to size up because it's moving and the prices are changing so quick. But it's just getting those reps over time and just building that consciousness just by little building blocks over time. I mean, Dominic, would you agree with that? I know you do your fair amount of decent trading. Do you have any other advice? Not to put you on the spot.
No, absolutely. 100%. You just gotta be, I mean, you need 200 reps, just as you said, sounds a lot, but they are in fact not. So you need a lot more sample size. And then when it comes to sizing, just take it step by step to create the awareness for it, and then rely on your instinct in the end.
Yep. It's a lot of reps, and it's hard, man. You're talking making these connections really, really fast. So reps. Sadly, reps. Oh, the other thing that helps, I can't believe I forgot this, is that's where if you do the highlight reel and you're recording your tape and you can replay it, oh my God, does that help so much, right? Because you might need to wait a ton for other headlines, but if you build that database and you can retrade, seeing the headline, connect the dots, and say like, okay, what's my sizing? Think sizing. That's the best way to do it. I should have actually opened with that. But if you can record your screen, or Thinkorswim on demand or trading sim, whatever you want to use. If you can just get reps and reprogram yourself when it's not market hours, that helps so much. That was actually probably the most powerful thing. Mark is asking, what are some good recording programs? Camtasia, the kids use OBS now. Either of those. Yeah, a lot of people are saying OBS in the chat. I don't know which is the most efficient just CPU wise anymore and GPU wise. I'm kind of out of the game. I used to like have the efficiency just super optimized. But I don't know, maybe it's not even constrained anymore. And for most people, your trading isn't so constrained by this stuff anyways, unless you're necessarily doing breaking news where you don't want the lag. So yeah, probably OBS works fine. There was one other question. Oh yeah, so Dexter brought up the TNON craziness. Do you think it is even worth it to short small companies anymore? ZJ, why all happened? TNON, CCNT. Yeah, I mean the TNON. Yeah, I mean, that was a crazy, crazy, crazy move. Like, I mean, I do think you got to be so careful. Like, if you're a short bias trader, my God, you just need to be so ridiculously careful with what you're shorting. Like, I mean, I personally don't think people should have really been doing this. Like, I understand the logic. Like, I know people that got caught by this, and I understand the logic of why they were in the trade. But like the float on this thing is just so small. Like, it was kind of just day one. the reward is just kind of so limited to some degree. I mean, like we already moved so far back by the close. And I do think this does add another data point of the fat tail stuff. Like ZJYL, prior to that happening, you can make like here's what makes this hard, I guess. Like before ZJ, let's even take a step back. Like before 2020 and stocks and meme stocks and shit went crazy, the probability of $1 billion company making a crazy move was super, super low. Like then AMC and GME are going nuts and GME is going to the moon. Like when GME happens and this craziness happens and you realize price is just, you know, a figment, like you then need to update your probability set. It changes the whole universe of what's possible. And like, I would say the other data point that needed you to update your probability set of what's possible is the ZJYL. Like when ZJYL happened, that's when you need to say like, holy crap, like there can be, and I think this was split adjusted by now because it was really, it was 250-ish back then or something, something like that, whatever. Because the real question is like, what is the true probability of these outcomes occurring? And now here's the issue. When you're dealing with fat tails in a data set, by definition of it being the fat tail side of things, we don't really know what the true probability of this stuff occurring is, right? So when ZJYL happens, you know it's at least possible that you can get some absurd indication and it can open there, especially where there's locate issues and everything. The question is that a 1 in 100,000 chance? Is that a 1 in 10,000? Is it a 1 in 1,000? 1 in 10 million? It's really hard to say when you're talking about those tails. Like, you know, like it's same thing for like a meteoroid hitting Earth or like who really knows? And so what happens though is every data point that you think is a fat tail, if that increases, you need to get way, way, way more scared. When it's just ZJYL, you can think, oh, maybe this is like maybe this happens once every 5 years or once every 10 years. And I mean, this was December 2023. That's less than 1 year ago. Now Tenon happened less than a year later. And I would argue to some degrees, like, you know, this was equally bad. So now that we're getting at least one a year, I still don't know the true probabilities, but I do think you need to be a little scared. And especially based on the float. If you're shorting some of these low floats, it would really make me reassess, because at the end of the day, there's a lot of ways to make money. But for a lot of traders, if you blow up once, it's game over. Like, I really don't want to take blow up risk anywhere, right? And the other thing, keep in mind how totally like a print can happen that's totally absurd. And if everybody's getting liquidated and brokers are liquidating people, that creates a feedback loop, right? So let's say you have $1 million account or something. It might not take that much size, right? If you have, you know, like you might think, oh my God, like my point is if a $100,000 loss can occur, there's nothing that stops that from other people getting liquidated where price just becomes irrelevant, right? Like 130 was a just totally random arbitrary price. There's nothing that stopped this from being 170. And in ZJYL, when everybody was getting squeezed on that print, there was no reason that couldn't have opened 600. And the thing is, if that's going to liquidate you and that's going to end your whole livelihood and your career, like I don't view that as acceptable risk. So this is a long-winded way of me saying, like, there's no way to know the true probability and calculate the expected value, but like I would be really second guessing some of my short low float stuff. Certainly the sizing on it, but I don't know I don't know. Yeah. So long story short is yeah, I think if that's a bulk of your trading, you need to really do those thoughts. And me personally, I would not be comfortable with it. And honestly, maybe that's going to lead to further inefficiencies in low float world, you know, because maybe people will be less and less willing to take the short side of this stuff. And now here's the interesting thing. Here's the interesting thing about markets. The more people that are unwilling to take the short side of these stocks, actually ends up increasing the inefficiency and leading to more reward. So we might get a cycle where everyone's afraid to take on the short risk. And that actually makes it once again really enticing one day. I don't want to do it now while this stuff is occurring, but it might so happen that like the essentially like the risk premium goes high enough where it's justified and you just need to be super small. But yeah, I do think if someone is doing these strategies, you need to really put a lot of thought in. And I don't know the right answer, but I would be scared. That's my short answer. Does anybody have thoughts on that? Because I think it's an interesting subject. Agree, disagree, but it really. The other thing I would say is like the time to do these reflections was after ZJYL. If you didn't do that reflection then, the time to do it is after TNON. There will be people out there that see these data points, whether they're involved in them or not, and they don't do these reflections, and then they blow up and they're like, oh my God, there was no way I could have seen that coming. And it's like, well, I mean, the signs were kind of there that something changed and the risk is out there. You can't keep on calling this like a fat tail black swan when it's happening twice a year now. So you got to be careful. Yeah, it's scary.
I think Lucas said it in a good way. He was moving away from mainly shorting the low float stocks, because he was saying the only reason why he was able to make so much money in shorting these stocks were that he was always running at a higher risk of ruin that what you would actually want to have. And I think that's exactly what is displayed here. You have a very juicy potential reward on the shorts on these names. But then again, the risk of ruin and the black swan risk has so much increased over the past 1 or 2 years that you should really think about it twice, taking short trades on those names in a swing way.
You want to know actually. Yeah, that's a great point. And like, thank you for sharing that and 100% agree. And what I would say is if you're engaging in this type of trading, if you have assets, I would be doing this in a segregated account in a separate LLC.
Oh yeah, absolutely.
Yeah, and that's actually an interesting thing is if the risk premium, meaning the reward and meat on the bone goes up because nobody else is doing this, it could open up a really interesting opportunity for people to have a segregated account with a set amount of capital. And what you do is you pull your capital out, right? You only keep, again, it doesn't take crazy involvement. Maybe you have, again, I don't want to just throw numbers around that because everyone's at their own point in life. But if you're an experienced trader, maybe you have a 20, 30 grand account, 40 grand account or something, and you're able to pull, 10K a pop and you just withdraw and wire it out. And so there is a world where people are afraid to take positions in these, which leads to the edge going up and you can segregate your assets. And again, I don't want to speak to legality of like brokers coming after you or not, an LLC will or won't protect you. I obviously have no idea and I'm not a lawyer and everything else, but it's interesting to think about. But I do think if you're doing this, oh my God, do not be trying to make 10 grand in these in $1 million account and lose, 10 years of work or something. That's the most obvious. Would I ever trade size in these in my account? No, because it's no good. If you're a smaller trader there's a lot of traders that wire out like that and they just reload their accounts. Then okay, go for it. But yeah, that is scary to me. Good points, Dominic. Thank you. We need more Dominic on all these calls, man. Although I normally know I screw you on the time change, but
yeah, I gotta run now, and also my battery is empty from my laptop, and it's getting late here. It's midnight now. So.
Yeah, I knew you'd probably have bedtime soon. Well, thank you for your thoughts, and I look forward to seeing you in Vegas, and I'll figure out a meetup. It might need to be organized a little bit closer because there's some weird schedule stuff. But yeah, that's a no-brainer to do a meetup, which I don't think you were on the call yet, but I said that. Yep.
Yeah, true. Yeah, cool. Looking forward to it and see you all there. Have a
Hopefully
good
to
one.
eating many dumplings at Din Tai Fung or something.
Awesome. See you there. Thank you.
Good,
Bye-bye.
Dominic. Thank you.
Lance, I just wanted to add my thoughts if possible.
Yeah.
So before joining your service, your room, I exclusively shorted low floats, and a lot of the traders I knew also did that. But a lot of them stopped doing it recently, and they've been doing it for super long periods of time. And they've noticed like historically the fees and stuff, like for the locates, for example, they've just gotten like exponentially higher because there's so many people taking this type of trade. It's just gotten so crowded and competitive to get the locates themselves, right?
Yeah, I mean, yeah, that's what happens I mean, I can't explain to you guys how floored I was when I started doing retail Twitter world. And it was just like, what? Like, why do you guys only trade this crap? Like this stuff is like, most of this stuff is dog shit. Like my mind was blown. It was just like, guys, like every single person on retail world Twitter is like, just all cannibalizing like the smallest, like most dangerous section of like the market when it's like, dude, no one's trading all this other stuff with like infinitely better liquidity and amazing opportunities. It's like, why is everyone fighting for like super expensive locates and taking blow up risk and crazy shorts? It's like, what are you guys doing? Like I consider like low float short world, like one of the most dangerous parts of trading. And yes, like I'm sure that like definitely like led to initial opportunity over time, but yeah, there's a ton. Yeah, then of course, like Ozzy said, is like then the people that only trade SPY and like NQ, that was super odd to me. Like nobody, I don't know a single professional trader that only trades those. Also, let me take this moment to say such an LOL at all the traders that talk shit, then only trade SPY, but then nobody like to this day. I mean, I don't know how many years it's been. Nobody has still met my one Furu challenge, which the bar was insanely low. Like, so I don't know if these SPY traders and these NQ traders are making money. I'm sure some are, don't get me wrong. Actually, I know some are, like people that I'm familiar with have said, hey, I know some traders that do this, but not the marketers. To my knowledge, there is still not a single marketer that has met my criteria. And again, there are traders doing it without a doubt. I know that. But yeah, this TIL, I mean, yeah, price is broken. So, I mean, this definitely fits the criteria. And, what could this do on Monday? I have no idea. This is a stuff you got to be cautious of. Let's do a couple more questions because we're going on the 3-hour mark and my voice hurts a lot. So even for short offerings, BCTX, yeah, I mean, yeah, it's true for all these things. Yeah, this is a good discussion. It's an important discussion, and the crazy part is like there will be traders that won't pay for the Patreon, which is $50 or whatever, and then they'll blow up, with the 50 grand account, not even thinking about it, But yeah, what other questions? Let's take a couple easy layups for me, and we'll call it. Or maybe there's no easy layups. Maybe we exhausted. Oh, Roberto, you always sneak them in.
I have always a little one. The slower trades. I was reflecting on your answer on sizing, because as I expressed earlier, breaking news. I'm getting very good at it, so I'm taking that trading model as my main one. Now that I can do it, I have the time, I have the willing. But that answer keeping me thinking about how to reorganize my playbook and my trading business. So given that context, you know what? Let me think some more about the question.
Yeah, sure. And what I would say real quick is like you can, even if maybe your whole business is breaking news, so it's like, oh man, how can I get better at slower trades? All my trades are fast. That's where what you do is you use the recordings and you slow the recordings down. And like it's just like with my little golf swing, right? I'm sorry everyone needs to suffer through my golf analogies on my journey to not suck. But it's like with my instructor, dude, he has me swinging super, super, super slow so I can get the movement. And like if I swing fast and I do it wrong, what did I do? Did I make progress? No. Like anytime I swing fast because, oh, you feel like an idiot swinging so slow, he just says, congrats, Lance, you just moved backwards, right? Because like if I ingrain the wrong habit, like that actually hurts me. If I go to the driving range and I hit 200 balls using bad habits, I didn't get any better. I got worse, right? And so what you so often want to do is just like slow it down, get the reps, and process everything exactly. Okay, I read the headline. Headline is good. These are the exact keystrokes I need to type. This is exactly how I should be thinking about the risk. I'm conscious about this. A, B, C, D. It's like with my golf swing. I know, okay, turn from the hips, bring it, this arm goes straight. Then I need to initiate, with the hip turn, blah, 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 blah. I'm going through this checklist at super slow speed. So then it becomes more natural in the moment. And then, of course, it still just takes a zillion reps. So yeah, I hope that helps for that. Any final quick things before I call it? Going once, going twice.
Okay, the last one. Okay.
Okay. 3 times old.
The second thoughts are because the rest of my playbook is something like systematic. I can literally make an algorithm on those 2 other traits that I have. So my question here is, because bad ideas before, maybe following the wrong kind of people in this world of trading, so they tell you things like, okay, algos or systematic trading is not that scalable and things like that. So I want to ask
tell Citadel and
someone
Jane
like you.
Street. Tell Citadel and Jane Street that algorithmic trading isn't that scalable.
Yeah,
of course, it just depends where you implement it. There's nothing wrong with that. It's awesome. If anything that makes money, who's going to argue with it? And people on the here's what I've realized. Here's what I've realized about people on the internet. Like my patience for anonymous people is 0, right? Because you don't know what their background. Like you could think, oh man, maybe that person knows what they're talking about. It could be a 14-year-old kid on the other side. It could be a 22-year-old kid. It could be a 50-year-old that's been trading 1 week and just has never traded in their life. So it's like my general patience to listen to people where you don't know their background or their biases or their conflicts of interests or everything else. It's like, if I'm going to debate some trade online, I need to know, am I debating with a 19-year-old that's negative 5,000 lifetime P&L? Or am I'm open to debate, but it's generally not conducive online because you don't have this information. It's like, if you're going to tell me, Lance, you're having a discussion with a 20-year trader and he has 100 million in net P&L, it's like, okay, this is a good discussion. I'll engage in this. But that's never the case. All the people, with the internet, it's free to have a view. There's no skin in the game. You can voice any opinion you want. So it's like, you don't want to there's so much just total fallacies and bullshit out there on the internet that's taken as belief. Oh, you need to have 3-to-1 reward to risk. The magic of R, this or that, like we were talking about with Sean last time. And it's like, you need to just develop the ability to just independently think and find these things out for yourself. And oftentimes the consensus is wrong, and that leads to opportunity. And if everyone's going to think, oh, there's no money and no scalability in algorithms, guess what? There's someone out there doing it. And in fact, Jane Street and Citadel and Jump, that's their whole business model. And they're making more money than anyone in the world.
Jim Simmons, etc., etc.
Yeah, Jim Simons, yeah. Well, gang, it has now been 2 hours, 45 minutes. I need a voice and a break. So it has been a pleasure. Amazing questions. I mean, I really enjoy doing these AMAs just because it really gets so much participation. It's nice connecting with you all in person. If you guys have not linked up with each other, please do your best to do that. Like, you guys have so much to offer to each other. If you're going to Traders for a Cause, we're going to do some type of meetup. Hopefully Din Tai Fung. Hopefully I will spend at least $1,000 on dumplings, and I will be disappointed if they do not get eaten. So thank you all for attendance. And it is a pleasure, my friends.